Beneath the surface of the global economy lies a subtle yet profoundly significant pattern, one that most individuals will never consciously recognize, as it remains hidden from everyday awareness. This pattern is not part of mainstream education. It is not taught in schools, nor do financial advisors discuss it with their clients. Furthermore, the mass media tends to overlook or dismiss it entirely. Yet, despite its obscurity, this underlying cycle has, over the past 2 centuries, served as an extraordinarily precise predictor of every major economic downturn or crisis. It has accurately foreshadowed the catastrophic collapses of the year 1873, the infamous stock market crash of 1929, and the financial meltdown of 2008. Astonishingly, current analysis indicates that this identical pattern is signaling a significant downturn set to occur around the year 2026. Not in 2027, nor sometime further into the future, but specifically in the year 2026. The numbers are backed by meticulous mathematics, and the historical record provides undeniable, compelling evidence. Recognizing and understanding this pattern enables one to anticipate these crashes months in advance, long before widespread panic takes hold on Wall Street, in the markets, or among ordinary investors. It's important to clarify that this insight is not rooted in any conspiracy theories, nor does it rely on fear-mongering or paranoia. Instead, it rests on the reality of cyclical behaviors, regular, predictable fluctuations that repeat with the unwavering consistency of changing seasons. Just as winter invariably follows autumn, and spring follows winter, economic booms and busts are similarly bound by natural cycles. These cycles are governed by systematic, mathematical principles, and their recurrence is as reliable as the cycle of the seasons themselves. Today, I want to focus on a particular cycle that was first uncovered nearly a century ago by a Russian economist named Nikolai Kondratiev, though his name is often transliterated as Kondrat. During the 1920s, Kondrat meticulously analyzed decades of economic data stretching back to the 1700s and identified an extraordinary pattern, a long wave oscillation repeating roughly every 40 to 60 years. This wave comprises 4 distinct phases: spring, summer, autumn, and winter, that correspond to periods of recovery, expansion, stagnation, and decline. In essence, these phases represent cycles of growth, prosperity, relative stagnation, and ultimately collapse. Currently, according to this long wave analysis, we are firmly entrenched in what is known as the winter phase. This stage has historically, without exception, culminated in severe financial crises, collapses, and economic upheavals. Kondrat's contribution was not merely theoretical. He established his claims with extensive data, tracking prices, interest rates, production levels, and commodity prices over many years. He demonstrated convincingly that these long waves did not represent random fluctuations in the economy, but were instead predictable, pattern movements driven by recurring factors such as technological innovation, the buildup of debt, and the disintegration of outdated economic structures to pave the way for new growth. Regrettably, Kondrat's findings were considered threatening enough to challenge the official Soviet narrative that proclaimed eternal prosperity under communism. As a result, he was arrested in 1930, and during his imprisonment, he died in a labor camp in 1938. Nonetheless, his cycle theory persisted beyond his lifetime, and numerous subsequent analyses have confirmed its validity time and again. So, let me give you a clearer picture of how this long cycle actually unfolds. The initial phase, known as spring, marks the period immediately following a major crisis, a phase of recovery and renewal. During spring, the economy begins to rebuild its infrastructure, confidence gradually returns, and new technologies start to emerge from the remnants of the old economy. Debt levels during this period are typically low because the previous crisis has often wiped out much of the bad debt accumulated earlier. Interest rates tend to be low, prices remain relatively stable, and optimism begins to cautiously build among economic participants. A noteworthy example of this spring phase was following the devastation of World War II. The 1950s can be seen as a classic spring period. The United States undertook a massive rebuilding effort, extending suburbs into previously undeveloped areas, constructing the interstate highway system, and witnessing the widespread adoption of television, all while the economy experienced consistent growth. During this time, inflation was contained at modest levels, and the mood was cautiously optimistic about the future. Next comes the summer phase, often called the boom years, when the innovations introduced during spring mature and become widespread throughout the economy. Employment reaches high levels, wages are on the rise, and inflation begins to accelerate as demand surpasses supply. During this period, many people feel prosperous, and there's a sense that the good times will never end. The stock market often experiences a steady climb, reflecting this confidence. The 1960s exemplify this summer, the excitement of the space race, the height of American manufacturing dominance, a tight labor market, and falling unemployment rates all point to a period of extraordinary economic confidence and growth. It is during this summer that prosperity often reaches its peak, setting the stage for inevitable transition into the next phase, a period of stagnation or decline. But before moving into that, the summer phase is characterized by rapidly expanding technological innovation and increasing societal wealth, which in turn fuels consumer spending and investment. Yet, beneath this seeming prosperity, warning signs are often subtly emerging, indicating the impending shift, but they are frequently ignored or misunderstood in real time. This detailed explanation of the long wave cycle and the phases it encompasses reveals a pattern that is as natural and predictable as the changing of seasons. Recognizing where we are within this cycle, particularly as we approach the winter phase, can offer invaluable foresight, enabling investors, policymakers, and individuals to prepare for the economic storms that are mathematically inevitable. Beneath the surface of the current economic landscape, a series of deeper, more profound issues are quietly but unmistakably taking shape. Increasingly, debt levels across the globe continue their upward trajectory, expanding toward levels that threaten to destabilize financial systems that are already stretched thin. Simultaneously, inflation appears to be gaining momentum, moving faster and more aggressively than many policymakers had anticipated just a few years ago. Amid this environment, debt continues to accumulate at an alarming pace because a widespread belief persists that the current boom will somehow reignite, making the rising debt levels sustainable. This mindset echoes the economic landscape of the late 1970s and early 1980s, a period marked by stagflation, a distressing combination of high inflation, sluggish economic growth, oil shocks, and rising unemployment. During those years, the feeling was that the economy was stuck in a frustrating stagnation, unable to move forward despite the appearance of a prolonged expansion. This autumn phase was, in reality, a precursor to winter, the harsh season of economic contraction that inevitably follows when imbalances become unsustainable. Winter, in this context, signifies the crisis point, the period of reckoning when accumulated debts become unpayable, bubbles burst, and financial institutions falter. Banks collapse under the weight of bad loans, trillions of dollars of wealth evaporate as markets crash, and unemployment surges to levels unseen in a generation. Deflation, a general decline in prices, or a deep recession takes hold, bringing the economy into a severe correction. This phase is often referred to as the Great Reset, the painful but necessary process of cleansing the economy of all excesses accumulated during previous phases. Businesses that had survived solely due to cheap credit go bankrupt, over-leveraged investors lose everything, and only those who had prepared for the oncoming winter manage to endure. This cycle of boom and bust is vividly illustrated by the Great Depression of the early 1930s. During that time, thousands of banks failed, unemployment skyrocketed to about a quarter of the workforce, and the stock market plummeted by nearly 91% from its previous peak. It took more than a quarter of a century for stock markets to fully recover their pre-crisis levels, marking a profound and prolonged winter that left a permanent scar on the global economy. Yet, this cycle does not simply reset and start anew without influence from the events that came before. After winter, spring inevitably follows, a period of renewed growth and recovery. As history has shown, the 1950s and 60s represented such a spring, a time of rebuilding and expansion. Then, the cycle repeated itself. The 70s experienced summer-like growth, followed by autumnal downturns in the 80s and 90s. The most recent winter arrived in 2008, with the global financial crisis effectively plunging the economy into another severe downturn, a winter of its own. But here is the crucial point. The crisis of 2008 should have been much worse, likely a complete and devastating Kondratiev winter that would have swept away all the imbalances and excesses, cleansing the system entirely. Instead, governments and central banks intervened on an unprecedented scale, employing extraordinary measures to shield the economy from collapse. They bailed out banks, slashed interest rates to zero, and printed staggering amounts of money, trillions of dollars, to keep the wheels turning. These interventions, though averting immediate disaster, primarily served to delay the inevitable winter. They postponed the full force of the correction rather than eliminating the cycle altogether. This strategic delay means that the winter that was expected to fully materialize between 2010 has been continually pushed back, now almost 15 years, thanks to sustained artificial monetary policies and relentless debt accumulation. However, no amount of intervention can defy the fundamental laws of economics forever. Eventually, the existing imbalances grow so vast and entrenched that no amount of tinkering or liquidity injections can prevent an unavoidable correction. The point at which this occurs is rapidly approaching, and 2026 stands as a critical juncture where multiple cyclical indicators align, pointing to the same unavoidable conclusion. The delayed Kondratiev winter is finally unfolding. Looking at the concrete evidence behind this perspective, one can see that the original Kondratiev cycle, an overarching pattern spanning roughly 50 to 60 years from one peak to the next, has historically dictated the timing of major economic shifts. The last significant peak, marking the transition from the autumn phase into winter, occurred in the late 1960s and early 70s. Adding 50 to 60 years to that point points us squarely into the window of 2020 to 2030. And considering where we stand today, in the middle of this period, the signs are unmistakable that we are now within this critical time frame. While the broader long-term economic cycle provides valuable insights, a closer examination of the smaller, more specific subcycles within this overarching pattern reveals even more precise indications of impending upheaval. One such subcycle is often referred to as the debt supercycle, which intricately overlays the main Kondratiev wave, a long-duration economic rhythm that spans several decades. This overlay suggests that there is a point, roughly every 70 to 80 years, when the global financial system reaches an extreme level of debt saturation. At this juncture, the system effectively hits a ceiling, where it can no longer absorb additional borrowing without risking collapse or severe instability. Historically, this critical saturation point has been approached around the years of the Great Depression, specifically during the period from 1930 to 1940. When we add approximately 70 to 80 years to that time frame, we arrive at the decade spanning 2010 to 2020, which is when the previous cycle reached its peak. Remarkably, this indicates that we have already moved beyond that danger zone. In fact, we are currently operating within it. Yet, the story does not end with the debt supercycle. There exists another significant pattern, known broadly as the generational cycle, which influences economic crises over a human lifetime. This cycle spans roughly 80 to 90 years, a duration comparable to the average span of a single person's life. The core idea behind this pattern is that societies tend to forget the painful lessons of previous crises as each new generation comes of age. Those who lived through the catastrophic events of the Great Depression, gaining firsthand knowledge of its root causes and consequences, are no longer among us. As a result, current generations have no direct experience of a true economic catastrophe. This collective amnesia fosters the psychological environment necessary for history to repeat itself on a grand scale, because the warning signs are ignored or misunderstood by those who have yet to learn firsthand what such turmoil entails. The last peak of this generational cycle, an event marked by widespread societal crisis, occurred between 1929 and 1933, precisely during the global economic collapse known as the Great Depression. Extending this cycle by another 80 to 90 years brings us directly into the years of 2019 to 2023. The timing of this coincidence is striking. It underscores how these separate cycles, each with their own internal rhythm, are converging on similar dates. When such cycles align, their combined influence can magnify the severity of the resulting crisis, often producing a scale of upheaval far greater than that caused by any single cycle alone. Currently, all these critical cycles, the Kondratiev long wave, the debt supercycle, and the generational cycle, are converging within a narrow, 5-year window from 2022 through 2027. Within this period, the most probable flashpoint, the actual moment when systemic stress reaches a breaking point, appears to be in the year 2026. More precisely, analysis of these interconnected subcycles and current economic indicators suggests that the moment of greatest vulnerability will occur not at the beginning nor at the very end of this window, but rather in the middle, during late spring or early summer of 2026. It is at this time that the accumulated pressures on the financial system are expected to reach their maximum, setting the stage for a potential crisis. To understand why this specific year, 2026, is so critical, we can look at the leading indicators embedded within these cycles, which serve as early warning signs for imminent economic upheaval. One of the most reliable and well-documented among these is the phenomenon known as the yield curve inversion. Under normal circumstances, long-term interest rates are higher than short-term rates, reflecting the greater risks associated with lending over longer periods. However, when investors expect a downturn, they often seek the safety of long-term bonds, driving their yields down and causing the curve, depicting the relationship between short and long-term interest rates, to invert on a chart. Historically, every recession recorded since the 1950s has been preceded by a yield curve inversion, with no exceptions or false signals. The most recent inversion occurred in July of 2022. It persisted for more than 2 years, a notably prolonged inversion by historical standards, and only finally returned to a normal, non-inverted state in September of 2024. Based on historical patterns, recessions tend to follow this kind of inversion approximately 6 to 18 months later, once the yield curve normalizes. By adding this period to the uninversion date of September of 2024, we arrive at a time frame between March of 2025 and March of 2026, within which a recession becomes highly probable. Another critical leading indicator is the widening of corporate credit spreads. This metric measures the difference in interest rates between loans issued to the safest borrowers, such as large, established companies, and those extended to riskier borrowers. When spreads are narrow, it signals that investors are comfortable and perceive little risk. Conversely, when these spreads suddenly widen, it demonstrates that investors are growing increasingly fearful and are flocking to safer assets, thereby demanding higher returns to compensate for perceived risk. Typically, a sharp widening of these spreads occurs just before a major economic downturn. Currently, we are witnessing an increase in credit spreads after they had been compressed for a prolonged period. This early phase of widening began around the end of 2023 and has accelerated throughout 2024. Drawing from historical precedent, such widening of credit spreads generally precedes a crisis by about 12 to 24 months. Therefore, considering the start of this widening process in late 2023 and adding this period, suggests that we could see the most significant market stress or the actual crisis unfolding sometime between late 2025 and late 2026. Taken together, these two leading indicators, the yield curve normalization and the widening of credit spreads, point toward the same crucial period, reinforcing the likelihood that the year 2026 will mark a pivotal moment of systemic vulnerability in the global economy. A third crucial indicator that financial analysts and economists closely monitor is the velocity of money, a measure reflecting the speed at which money circulates and exchanges hands within an economy. Essentially, it indicates how rapidly funds are moving through different sectors, influencing overall economic activity. When confidence among consumers and business owners is high, people tend to spend more freely and promptly, leading to money changing hands multiple times over a given period. This vigorous circulation stimulates economic growth, fosters job creation, and boosts investment. Conversely, when confidence wanes, individuals and companies become hesitant to spend. Instead, they choose to hoard cash and keep savings intact. As a result, the velocity of money diminishes, signaling a slowdown in economic momentum. These loans, originally issued when interest rates hovered around 2 to 3%, must now be refinanced at current interest rates predominantly between 7 and 9%, a substantial increase. Many properties are simply financially incapable of supporting the higher debt service payments at these increased rates, leading to a wave of defaults. Should these defaults reach a critical mass, regional banks heavily invested in this sector could face insolvency. When regional banks fail due to these defaults, the entire credit market risks freezing, as banking institutions tighten lending in response to mounting losses. This credit contraction would ripple outward, causing the broader economy to stumble and potentially collapse. Notably, the steepest period of refinancing difficulty is anticipated in the initial and second quarters of 2026, marking this time frame as the most precise timing window for the impending crisis. To understand the broader pattern, it is useful to step back and view the situation in the context of what economists call the everything bubble. The delayed bursting of the financial bubble in 2008 created what is often referred to as an everything bubble, where multiple sectors inflated simultaneously rather than sequentially, as in previous bubbles. Historically, bubbles have often formed in a single industry or sector, such as real estate in 2008 or technology stocks in 2000. During the 1920s, the stock market was the main bubble. But following the interventions after the 2008 collapse, the fundamental difference was that policymakers flooded the entire financial system with unprecedented levels of liquidity, causing virtually all asset classes to inflate together. Stock markets reached record highs. Bond prices surged to historic levels. Real estate markets hit new peaks. Emerging cryptocurrencies generated their own speculative bubbles, and even art collections and rare collectibles soared to irrational valuations. This widespread inflation across multiple asset classes was driven by the Federal Reserve's aggressive and unprecedented monetary stimulus measures. This phenomenon creates a unique and challenging problem for investors and policymakers alike. When virtually everything is inflated in a bubble, the usual strategy of simply moving assets into supposedly safer investments loses its effectiveness because there are practically no truly safe harbors. During the last major crisis in 2008, bonds were considered a safe haven. In 2000, when real estate was in a bubble, real estate was viewed as a safer asset. But during this current all-encompassing bubble, conventional safe assets are no longer reliable, complicating risk management and forecasting the timing and severity of the impending economic downer. Back in the year 1929, the financial markets experienced a period of intense turmoil, yet over time, the value of bonds eventually stabilized and became regarded as safe investments after the initial shock had passed. However, the situation that unfolded then was fundamentally different from what's looming in the upcoming crisis. The core issue lies in the fact that during that era, the decline was largely isolated. Assets that had been inflated quickly deflated, but the overall financial system was not simultaneously deflated across the board. In stark contrast, the next crisis, which many now anticipate for the year 2026, is expected to be far more devastating because everything, meaning all asset classes, tends to deflate together. This phenomenon occurs because the entire economy had, over a significant period, been inflated in unison, creating a massive, interconnected bubble across every segment of the financial landscape. What makes this upcoming crisis potentially more severe than any previous financial winter is the unprecedented level of interconnectedness and correlation now observed among diverse asset classes. Historically, there might have been declines in particular sectors or markets, but today, the links between stocks, bonds, real estate, commodities, and other assets are tighter and more intertwined than ever before. The underlying foundation of this potentially catastrophic scenario is the staggering amount of debt accumulated globally, which forms the backbone of what is often called an everything bubble. To put things into perspective, in the year 2023, global debt had skyrocketed to a staggering sum of $37 trillion, an amount that far exceeds most people's comprehension. This tremendous debt load is equivalent to around 340% of the world's gross domestic product. meaning that the entire world now owes more than 3 times the annual economic output it produces within a single year. For further context, during the darkest days of the Great Depression in 1933, the United States debt-to-GDP ratio had peaked at approximately 260%. Currently, that figure is significantly higher, reflecting a much more fragile financial environment. Particularly alarming is the debt held by major corporations in the United States, which now surpasses the sum of $11 trillion. Much of this corporate debt is what is commonly referred to as zombie debt, loans extended to companies that are barely able to service the interest, let alone the principal. These companies survive on the tenuous lifeline of artificially suppressed interest rates, which have remained historically low for more than a decade. Now, with interest rates beginning to rise and remaining at elevated levels, many of these zombie corporations are destined to fail. As these failures occur, lenders suffer substantial losses, which in turn leads to a tightening of credit. This constriction of credit acts as a downward spiral. When lenders face losses, they become more cautious, reducing lending to even healthy companies. As financing becomes increasingly difficult for legitimate firms, the entire economic fabric begins to unravel more rapidly, creating a feedback loop of declining confidence and mounting defaults. Particularly crucial to understand is the role of government debt, which underpins the entire financial system. The United States federal debt alone has approached an astronomical $36 trillion and continues to rise. The annual interest payments on this mountain of debt now exceed $1.2 trillion, an amount larger than the entire defense budget or Medicare spending. The biggest single line item in the federal budget is now the interest on past borrowings, a situation that is fundamentally unsustainable over the long term. For many years, this was manageable because interest rates were kept deliberately low, but that era has come to an abrupt end. In the past 18 months, the Federal Reserve undertook the most rapid series of interest rate hikes since the early 1980s, lifting rates from near zero to over 5%. This swift increase has dramatically amplified the country's interest burden. Within approximately 2 years, interest payments are projected to surpass $2 trillion annually, and within 5 years, they could consume around 40% of all federal revenue, an untenable scenario for any government. The math simply doesn't add up for such a debt load to be sustained indefinitely. As these debt levels escalate, only 3 main options remain to address the crisis. First, default, which would collapse the currency and severely damage the credibility of the government. Second, engender inflation, which would erode the currency's value and wipe out the savings of countless individuals. Or third, impose austerity measures that would trigger recession and widespread social unrest. While each of these options carries significant drawbacks, governments tend to favor inflationary solutions because they are less visible and easier to implement in the short term. The pattern observed in previous times of financial distress, often referred to as winters, has been to initiate massive money printing, which initially provides a temporary sense of relief, only to be followed eventually by systemic collapse and deflation. Historically, such episodes have culminated in monetary devaluation, economic downturns, and social upheaval. Presently, the Federal Reserve finds itself caught in a trap. If it maintains high interest rates in an effort to combat inflation, it risks crashing the economy and sparking a wave of loan defaults. Conversely, if it lowers rates and continues to print money to stimulate growth, it risks reigniting inflation, thereby irrevocably damaging the currency. This no-win dilemma leaves policymakers with only difficult choices: endure the immediate pain of high interest rates and economic slowdown, or face the catastrophic consequences of unchecked inflation and systemic collapse later on. Ultimately, they are confronted with the stark reality that there are no truly good options, only less bad alternatives, and the decision they make now will shape the nature of the crisis that lies ahead. Drawing lessons from history, it is clear that central banks, when faced with looming financial crises, tend to prefer postponing the painful adjustments for as long as possible. This tendency to delay often results in an eventual escalation of the crisis, making it far more severe once it finally unfolds. Based on typical patterns observed across time, it is highly probable that the Federal Reserve will begin to cut interest rates toward the end of 2024 or into the early months of 2025. Such a move would serve as a temporary measure aimed at providing a brief respite for markets and the economy at large. Following this, financial markets are likely to experience a significant rally, giving the impression that the worst of the economic downturn has been avoided and that conditions are stabilizing. However, this relief is likely to be deceptive, merely serving as the final burst of inflated prosperity, what can be best described as the last bubble, before the inevitable storm erupts. The final collapse, or what might be termed the delayed winter of the economic cycle, is predicted to arrive in the year 2026, bringing widespread turmoil and hardship. Allow me to guide you through what the progression of this forthcoming crisis might resemble if we draw on the well-established historical pattern of what can be called the winter cycle. The earliest stage in this sequence is what we might call the crack. It is at this point that some fault or flaw in the system finally manifests itself visibly. Something breaks. This could take many forms: a major bank failing unexpectedly, a sovereign debt crisis erupting in a key European nation, a collapse within China's troubled real estate market that triggers a domino effect across global markets, or a string of corporate defaults causing credit to tighten abruptly and panic to sweep through credit markets. The specific nature of the initial trigger is less critical than the fact that, after years of mounting pressure, an observable fissure appears in the once seemingly stable financial structure. Generally, such a crack manifests between 6 and 12 months prior to the full-blown crisis, and based on our projected timeline, this fissure is expected to emerge in late 2025 or very early 2026. When the crack appears, policymakers and authorities are likely to respond with denial and minimization. They will describe the crack as an isolated incident, a one-time anomaly, and insist that it does not reflect any systemic failure within the broader economy or financial system. They will emphasize otherwise positive indicators such as robust economic growth figures and low unemployment rates. They will claim that the fundamentals remain solid and that the economic fundamentals are strong enough to weather the storm. This pattern mirrors what was observed in 2007, shortly after the first subprime lenders began to experience problems, and again in 1929 following several sharp market declines earlier that same year. The stage of denial is a typical part of the pattern. Authorities are reluctant to admit systemic weakness because such admission could exacerbate panic, accelerating the process of collapse. They tend to cling to the narrative of resilience until it becomes impossible to deny reality any longer. The second phase in this inevitable cycle is known as contagion. Once the initial crack appears, its effects rapidly spread through various sectors and markets. For example, the failure of a major bank can cause depositors at other banks to become increasingly nervous and withdraw their funds. If a country defaults on its debt, investors begin to doubt the stability of other nations with similar vulnerabilities. Similarly, trouble within a corporate sector prompts lenders to pull back from all borrowing, regardless of the individual borrower's health. This collective fear feeds itself, snowballing into a self-fulfilling prophecy. As confidence evaporates, credit markets freeze completely. No one is willing to lend money to anyone, because no one knows where the true risks lie, and thus, all lending grinds to a halt. This exact situation unfolded dramatically in September of 2008, after Lehman Brothers filed for bankruptcy. Credit markets all but stopped functioning, causing a collapse in borrowing and leading to widespread economic distress, with companies unable to secure funds for payroll or operation. The contagion phase typically lasts between 2 and 6 months. In the context of our projected timeline, these turbulent times could transpire during the spring and early summer months of 2026. Following the phase of contagion, the next stage is marked by what is called intervention. Faced with the collapsing system, governments and central banks are expected to plunge into frantic efforts to stabilize the situation. They will initiate unprecedented measures, slashing interest rates to zero or even below, printing trillions of newly created currency units, and providing substantial bailouts to failing banks and vital financial institutions. Additionally, new lending programs will be launched, and governments will deploy expansive fiscal stimulus to flood the economy with liquidity, hoping to allay panic and stave off a deeper collapse. These aggressive interventions will temporarily stabilize markets and create the illusion that the worst is behind us. However, such measures are only ever a temporary fix. They do not address the fundamental problems beneath the surface, merely delaying the inevitable reckoning. This phase of intense intervention might last anywhere from 3 to 12 months, contingent upon the aggressiveness of the actions undertaken by authorities. In our projected timeline, this turbulent period is anticipated to stretch from summer into the autumn of 2026, during which time the global economy will be held afloat with massive injections of monetary and fiscal support, providing a false sense of security before the coming storm. In summary, this pattern reflects a predictable yet tragic cycle. An initial fissure, swift contagion spreading chaos, followed by frantic governmental efforts to contain the damage, leading ultimately to an unavoidable and even more devastating final collapse. Understanding these stages helps us grasp the likely unfolding of the crisis, illustrating that what appears to be a temporary recovery is often merely a last gasp before the deep winter descends, bringing with it widespread hardship, economic dislocation, and profound uncertainty that will reshape the global financial landscape for years to come. The fourth stage in this economic cycle is what can be aptly described as the secondary collapse. It's at this point that the true realization begins to dawn on people. The intervention measures, policies, or rescue efforts that were implemented earlier have evidently failed to prevent further downturns. Markets that had previously surged in response to stimulus packages and government bailouts lose their momentum and start to decline once more. However, this new downturn is often more severe and rapid than before because the initial confidence that sustained the rally has been shattered, leaving investors more distrustful and cautious. As a consequence, unemployment rates escalate swiftly and relentlessly, reflecting an economy spiraling downward. The pace at which businesses go bankrupt accelerates significantly, with many corporations unable to withstand the mounting financial pressures. Simultaneously, government revenues from taxes experience dramatic declines, collapsing to levels that no longer fund essential public services adequately. In order to bridge the fiscal gaps, governments find themselves compelled to borrow more and more, increasing their debt burdens just to maintain the bare minimum of social and economic functions. During this tumultuous phase, social unrest begins to swell among the populace, fueled by the widespread loss of jobs, homes, and accumulated savings, which leaves many feeling desperate and betrayed. This stage, often regarded as the core of the Kondratiev winter, typically endures for a period ranging from 18 to 36 months, with some fluctuations depending on specific circumstances. When we map this cycle onto our current timeline, this phase would extend roughly from the late months of 2026 through the years 2028. The fifth and final segment in this cyclical process is what we call the period of stabilization and reset. After the destruction wrought by the earlier phases, the economy must undergo a comprehensive cleansing process. This involves liquidating bad debts that have become unsustainable, allowing zombie companies, those surviving only through artificial support, to fail, and letting asset prices adjust to levels supported fundamentally rather than sustained purely by speculation. Once this cleansing is complete, the groundwork for a new economic cycle is laid. The survivors, those who have held on to their capital, emerge stronger, assets become more affordable or cheap, and new technologies and innovations begin to surface. This paves the way for the next spring, signaling renewal and growth. Nonetheless, reaching this rejuvenation occurs only after enduring years of hardship and economic pain. If we project this onto our current timeline, such a recovery might only become visible around the years 2029 or perhaps 2030 at the earliest. Understanding this cyclical pattern isn't about trying to predict every twist and turn with pinpoint accuracy. Instead, it's about recognizing when society is in the late stages of a major economic cycle and adjusting your strategy accordingly. Those who understand what the Kondratiev winter signifies generally do not try to time the precise top of the market or peak of the cycle. Rather, they focus on preparing well in advance. During the autumn phase, think of it as the period of abundance and rising optimism. They build up cash reserves, avoid taking on unnecessary debt, and steer clear of chasing after speculative assets solely because others are making money. They accept short-term underperformance of their investments and are willing to forego immediate gains in order to ensure long-term survival and readiness for the harsh winter ahead. This disciplined approach allows them to seize opportunities during the winter when asset prices are driven down to depression levels by acquiring assets at 20 to 30 cents on the dollar. Over time, these assets invariably recover their value, turning that small initial investment into a multiple of the original. For example, that 20 cents on the dollar eventually becomes $1, representing an extraordinary 500% return on investment. However, such strategic preparation requires consciously going against basic instincts and ignoring social pressures. During autumn, the prevailing atmosphere often feels like an optimistic bubble. Everyone around you appears to be making money, whether through stock market gains, real estate investments, or other assets. Neighbors talk excitedly about their recent successes, and the financial media collectively celebrates record market highs, attributing success to innovative technologies and claiming that the old rules no longer apply. Many investors feel a palpable fear of missing out, which makes the cautious approach seem almost like a form of missed opportunity. Yet, this is precisely the critical test. The individuals who resist the urge to chase fleeting returns, who remain disciplined and patient during this phase, are the ones most likely to survive the winter intact and to flourish when the cycle turns and spring arrives again. History offers compelling evidence of this cycle's potential for wealth creation. Those who position themselves correctly just before the onset of a Kondratiev of winter often achieved financial gains that can only be described as generational. For instance, investors who bought stocks during the depths of the Great Depression, in the years of 1932 and 1933, saw returns on their investments that remain unmatched by conventional standards. Similarly, those who purchased foreclosed real estate at bargain prices during the crisis of 2009 and 2010 built fortunes that continue to grow and be passed down through generations. Such opportunities do not present themselves often. Typically, they recur only once every 50 to 80 years. If you are adequately prepared and possess available capital when others are desperate and overwhelmed, you can acquire assets at mere fractions, 20 to 30 cents on the dollar, that will eventually recover to full value. In the long run, the recovered value of these assets often multiplies many times over, turning a modest investment into 5 times or even 10 times its original worth. In practical terms, that 20 cents on the dollar can become $1, representing a 500% return, an extraordinary gain by any measure. Nevertheless, achieving such success demands going against natural instincts and social pressures, especially during the autumn phase, which is when we find ourselves today. It is the period during which everyone appears to profit, and the temptation to follow the crowd is immense. Your neighbors, colleagues, and the entire financial media ecosystem promote the idea that now is the moment to invest heavily and chase returns. The feeling that missing out or playing it safe means falling behind can be overwhelming. But the real challenge and the ultimate test lie in having the discipline to resist this temptation. Those who can remain patient, avoid the lure of speculative gains, and maintain their cash reserves will be the ones who not only survive the inevitable winter, but also emerge stronger, ready to capitalize on opportunities that only come around once in a lifetime. The specific steps you should consider taking depend entirely on your current financial situation and the types of assets you hold. If your portfolio is heavily concentrated in stocks, the historical trends and past experiences strongly suggest that you should take significant action to reduce your exposure to the stock market, not by liquidating everything and shifting entirely into cash, but by scaling back your holdings considerably. For example, instead of maintaining a 90% stock allocation, it would be prudent to bring it down to somewhere in the range of 40 or 50%. The goal here isn't to sell off everything, but to create a substantial cash reserve that can be strategically deployed later, particularly when the market experiences a sharp decline or collapse. The proceeds from this reduction can serve as a kind of financial ammunition, enabling you to buy assets at the most advantageous moments. For those who own property, especially real estate purchased with borrowed money, the decision-making process must involve a careful reassessment of the numbers involved. If rental income drops by as much as 30%, will you still be able to service the debt without risking foreclosure or significant financial strain? If the answer is no, then it might be necessary to consider selling the property before the market turns against you, thereby preserving the equity that would otherwise diminish or vanish altogether in a downer. Individuals burdened with consumer debt, such as credit card balances, auto loans, or personal loans, should prioritize paying these off as a matter of urgency. During challenging economic times, what some might call winter, debt acts as a heavy anchor. It compels you to sell assets at the worst possible moments, often when prices are at their lowest, simply to cover ongoing payments. Conversely, those who are free of debt gain valuable flexibility, enabling them to wait patiently for the storm to pass. They are also better positioned to take advantage of others' forced sales, buying assets at bargain prices. The wealthy understand these dynamics well. They leverage debt strategically during more prosperous periods, or what can be likened to spring and summer, to maximize gains. At the same time, they are quick to shed debt before the winter season begins, ensuring they don't become trapped by their obligations when market conditions deteriorate. For individuals with substantial capital reserves, this period offers an opportunity to rethink asset diversification, not merely across stocks and bonds, which are likely to decline together during a crisis, but into assets that tend to preserve or even increase their value amid turmoil. Such assets might include physical gold and silver, which have long been recognized as stores of value, productive farmland capable of generating income, energy-producing assets that underpin essential services, or businesses that provide critical goods and services regardless of economic fluctuations. These are not speculative ventures, but serve as a form of insurance, protecting against the catastrophic devaluation of traditional paper assets like stocks and bonds during periods of crisis. Equally important, if not more so than the financial strategies, is the mental and psychological preparedness for difficult times. The conditions of winter, metaphorically speaking, test our resolve and mental resilience more than anything else. When everyone around you is panicking, when the media forewarns of the imminent end of capitalism, and when your investment portfolio has plummeted by 50%, potentially even more, the temptation to abandon your strategy and give up can be overwhelming. This is precisely when you need to resist the instinct to sell and instead focus on buying. To cultivate this mental fortitude, careful preparation is essential. Study past crises, reflect on historical downturns, and immerse yourself in the stories of individuals who endured and navigated the Great Depression. Recognize that what feels like the end of the world from your perspective might actually be a reset, an opportunity for those who are prepared to take advantage of new possibilities. Internalizing this understanding before a crisis arises creates a crucial psychological edge. During moments of chaos, rational thinking becomes extremely difficult, and emotional reactions tend to dominate. Another vital aspect involves timing your actions appropriately. Starting your preparatory steps too early may mean missing out on years of potential gains, while waiting until the last minute risks selling assets into a falling market after the worst damage has already occurred. The best approach is a gradual process. Recognize that we are in the late autumn phase of the economic cycle and begin shifting your assets systematically. This could involve selling between 10 and 20% of your stock holdings each quarter, steadily building up cash reserves with each paycheck, and aggressively paying down existing debts. Such incremental adjustments allow you to position yourself thoughtfully and strategically, avoiding the pitfalls of impulsive decisions driven by fear or greed. By the moment the first signs of an impending crisis become apparent, most individuals are already positioned within the unfolding scenario. In that critical period, trying to escape the tide alongside the crowd is rarely effective. Instead, the key lies in understanding the broader cycles that govern economic patterns. Throughout our discussion, we've examined several significant recurring patterns: the Kondratiev wave, the debt supercycle, and the generational cycle. These aren't certainties etched in stone, but rather probabilities rooted in nearly 2 centuries of economic history and observation. They serve as guiding frameworks, shedding light on the likelihood of certain developments based on past trends. Still, the question persists: could this time be different? Could technological innovations or policy interventions break these long-standing cycles? While such possibilities are theoretically conceivable, they remain highly unlikely in practice. The fundamental forces steering these cycles are not primarily technological or political. Instead, they are deeply rooted in human psychology, the collective behavior of market participants, and in the mathematical restrictions that limit how much debt can be sustainably accumulated. Technological progress undoubtedly transforms the way we produce goods and consume services, making processes more efficient and opening new avenues for growth. Similarly, policy shifts can influence short-term conditions and provide temporary relief or stimulus. However, neither technological advances nor policy adjustments fundamentally alter the core pattern: periods of rapid growth, followed by inevitable contraction, then recovery, only to repeat anew. It is this enduring cycle, booms culminating in busts, that has persisted for centuries and continues to shape economic realities. What makes the convergence point around the year 2026 particularly striking is our ability to observe the early signs of strain in real time. Current trends are alarming. Defaults in commercial real estate are on the rise, signaling distress in that property sector. Simultaneously, banks are tightening their reserves, making it harder to extend new credit. At the same time, consumer savings rates are falling, indicating diminishing financial buffers for households. Moreover, delinquencies on credit cards are increasing, further highlighting stress within household finances. Corporate profit margins are compressing, which suggests that companies are struggling to maintain profitability under mounting economic pressures. While each of these indicators alone would be cause for concern, their simultaneous emergence creates a comprehensive and troubling picture of an economy in its late stage of a cycle. It is not yet collapsing outright, but all the warning signs are present. The conditions speak clearly of approaching instability and potential crisis. The inversion of the yield curve that occurred in September 2024 served as a kind of starting pistol, an unmistakable signal to watch for, indicating that the clock of historical cycles has begun ticking down. From that moment onward, the conventional timeframes, 6 to 18 months, became critical. The window to prepare and react was set. This period is projected to close in the spring of the year 2026, marking the expected peak of the commercial real estate refinancing crisis. This crisis, unfolding in the first half of that year, will serve as a pivotal event, embodying the culmination of mounting stresses built over decades. The psychological echoes of winter arriving at specific historical junctures resonate profoundly. We are not uniquely special, nor is this generation fundamentally different from those before us. The cycle persists, relentless and indifferent to technological advancements or modern policy measures. Today, at the close of 2024, we are witnessing the transition from autumn into winter in real time. The signs are unmistakable. When the year 2026 finally arrives and the inevitable crisis unfurls, most people will claim that no one could have predicted it. They will dismiss it as an unpredictable black swan event or an extraordinary disaster that defied all expectations. But the truth is quite the opposite. The crisis will be exactly what the cycle patterns foretold, what the Kondratiev wave mapped out decades ago, what the debt supercycle explicitly warned us about, and what the generational cycle indicated was approaching. The information was readily available, and the patterns were clear to those willing to see them. The only real question was whether enough individuals and policymakers would open their eyes and acknowledge these signs before it was too late. If you are observing this in late 2024 or early 2025, you still possess time, though not much, yet more than enough to make meaningful adjustments. This period offers an opportunity to shift your investment strategy, to build up cash reserves, to reduce and pay down debt, and to prepare yourself both financially and mentally for what is to come. The window may be narrow, but it exists. The key is awareness, understanding, and proactive preparation before the cycle's final stages are fully upon us. By this time next year, it is highly probable that a significant crack in the system will have already begun to emerge. The mainstream headlines and news outlets will start to reflect the growing unease and nervousness as the warning signs become impossible to ignore. As we approach the spring of 2026, the phase of contagion, a period characterized by rapid spread and intensification of economic or financial instability, will be fully into motion, setting the stage for widespread upheaval. By the summer months, interventions, whether governmental or institutional, will need to be implemented with urgency and coordination, aiming to contain the damage before it spirals further out of control. Come autumn, the secondary collapse, the inevitable chain reaction following the initial shock, will be undeniably evident to all who are paying attention, revealing the deeper fragility of the system that many had previously taken for granted. This timeline, of course, hinges on the cycles aligning as they have consistently over the last 2 centuries. History shows a pattern that, despite its complexities, resonates with remarkable regularity. The impending crash, contrary to perhaps instilling fears of total destruction, is actually a mechanism designed to reset and reboot the economic and financial order of things. Its purpose is not to annihilate the future, but to cleanse the excesses accumulated over time, to liquidate unsustainable debts that have piled up, and to clear the way for a fresh cycle of growth and renewal. Every winter, each period of severe contraction or downturn, has historically been succeeded by a spring filled with promise and new beginnings. Every notable crisis, no matter how tumultuous, has eventually been followed by a recovery that revitalizes the system. Therefore, the true question is not whether the system will endure this turbulent time. The evidence from history suggests that it always does. The real question is whether individuals will manage to survive this upheaval with their capital intact and with sufficient clarity and understanding to recognize the opportunities that inevitably arise amid chaos and disarray. It is this awareness and preparedness that distinguish those who will emerge from winter wealthy, capable of capitalizing on the renewed growth, from those who will come out broken, battered by the storm. Hidden within the cycles and trends that have accurately forecasted major events, such as those of 1929 and 2008, there is a compelling indication pointing toward the year 2026. The mathematics underlying these patterns are transparent and well understood, while the historical precedents are well documented for anyone willing to examine them. Currently, the warning signs are unmistakable and plainly visible to attentive observers. The only element remaining in this equation is the decision, whether you will choose to prepare proactively while there is still time, or whether you will hold back, hoping that perhaps this cycle will break its pattern this time around. History sharply advises that betting on the hope that the cycle will somehow be delayed or avoided is an extremely costly gamble. The cycle itself, indifferent to hopes or pleas, continues its relentless turning, unaffected by human wishes or fears. The winter of downturn, which symbolizes the inevitable hardship ahead, is approaching with certainty. The only remaining question is whether you will be ready when it finally arrives, equipped with the foresight and resilience needed to navigate through the challenging times.